this is a slow moving or it's a super tanker turning, and it's like again, how did you go bankrupt, and how did you see the recession coming? It's like, first, first it was gradually, and then it was all of a sudden. And that's the same thing we're going to see with the recession. I mean, it's going to be a slow moving turn, and then we're going to see all of a sudden, and then it's there. So the Fed will follow. They will start to see, and I hope that they see it. And as I said before, I think they are already, very late. And I do not understand how they can even talk about I mean, the soft landing narrative is so naive that it's unbelievable.
Hi, and welcome to Wealthion. I'm James Conner, and today my guest is Henrik Zeberg of the Zeberg Report. And Henrik has had some very controversial calls for 2024 and beyond, including a recession that will be worse that we have seen since 1929. Henrik, thank you very much for joining us today. How are things in Copenhagen?
Thank you very much for having me on. And things are great here. The summer is coming, so we love it here.
And of course, the Euro Cup is going on in Germany. Are you a big soccer fan?
Not a huge soccer fan, but I have to follow it. Obviously, the Danish team is also there, so we will follow that, and we try to show our colors. But the first game was not as good as we have hoped for. So the Slovenian team actually played very well against us. So we drew against them.
I have to say, I love the passion of the European soccer fans, and I'm not sure if you saw that video that went viral, but of the Albanians breaking the spaghetti in front of the Italian fans.
I love it. I love it. Yes, just that's the way it's supposed to be, right? So a lot of fun, and then good spirit. So that's great.
That's right. Especially during these tough economic times, you got to find some humor. But anyhow, let's talk about the economy now and talk about the markets. And the last time you and I spoke, it was the last time we spoke on Wealthion, that is, it was in January of this year. And at that time, the S&P was around 4,800, and now it's at 5,400. Your target at that time was 6,100, and you said that was going to happen by June. But here we are in June now. It still is up 15% on the year, but let's just go through your thesis again and where you stand on the S&P and what your timeline is for meeting your targets.
So nothing has changed in terms of the outlook. So things have been moving slower than I've expected. That we still see a very clear uptrend, and actually I think we see an acceleration in the equity markets at this point here. I did expect that a little sooner because what would drive that acceleration is actually the anticipation of Fed getting back into the game, and we. So far the economy has been resiliently strong. We have seen the labor market, the job numbers coming out late. The most recent ones were really strong. Also, I think they were maybe a little too strong, and I also think that we're going to see a revision on those. But still, we have seen that it has been strong. The economy has been strong, and that is why we haven't seen, of course, the Fed really needing to start softening their stance in terms of the on the economy. But that is coming now, and we start to see the European, the ECB has already cut their rates first. We have seen also the Bank of Canada do the same. So I think it's just a matter of time where we'll see the Fed. And next meeting is in July, and we also have one in September. I think one of these will be the time where the Fed will cut.
And why do you think the Fed is taking so long to cut, especially with weakening economy? And when we look at the Q1 GDP numbers, I believe the first number came in at 1.6%, and this is down from last year when it was growing at 3%, but it was revised down to 1.3%. And it does look like the economy is slowing, but why do you think the Fed is taking so long to make a decision here?
Honestly, I think they're looking at the wrong numbers, and we know that they have an inflation as part of their mandate, that they need to keep inflation low. But the inflation is a lagging indicator or lagging parameter on the economy. So it's like looking out the rear window when you're driving forwards in your car. So you're looking out the rear window, and then you will discover later what actually it is that you go by when you drive forward. So that is what is happening to the Fed here. That's why they'll be hopelessly late again this time around, like they've been so many times before, both in terms of when they need to cut and when they need to hike. And so they are way past the time where they should have started cutting rates. So we have unemployment moving up now. We have most recent retail sales also seeming to be, showing a slowdown in the economy, and so on. There are many signals now, and in my models they are way too late. So I think they have been afraid of what they unleashed, or what they think they unleashed in terms of the inflation the last time around, and that's why they're kind of sitting on their hands now, saying, oh, we definitely do not want to trigger inflation because that's going to hurt the consumers. But the other thing is also a bad thing, and that's what they are up to doing right now, honestly. And again, it will come no matter what. And the last phase, just getting back to your previous question, also the last phase of when the Fed, not when they cut, but actually the moment up to that first cut is where we normally see that the markets really take off. And that's why we've seen that take off now. My timeline has then shifted a bit, and that is that I had to say, well, of course, when we got to, was it March or April, I said, well, you cannot reach these numbers by June, but it seems like now the September timeline is more realistic in terms of when we'll see the top in the stock market and in the crypto market, and also and then a recession potentially setting in like in Q4 of this year.
Henrik, you made an interesting comment about the ECB and that they recently cut rates, and they did so with the inflation still relatively high, and they made mention of that fact too. But I guess the threat they see is a weakening economy, and this is also hurting the consumer. Do you think the same thing is going to happen in the U.S.? That the Fed is going to wake up and say, okay, we still have high inflation. It's not near our 2% target rate, but we still see pain happening to the consumer, and therefore we got to start cutting rates.
Absolutely, and they have to, and I think the market yields will start to pull them downwards also. So we have to understand also that the Fed often will follow the market yields. So we will see that 2-year yields will start to decline very fast as we start to get going, as we get closer to the point where it's becoming very obvious to everybody that the economy is slowing and the recession is ahead. So yes, I think that is happening. And if you look at it, the interest payments of for the consumers are just skyrocketing. They have skyrocketed. They have been moving up faster than anything we've seen over the last 70 years, at least for as long as I have data. Which means that we're seeing the consumer first. It's very simple. You have to pay your interest rates instead because the interest rates are so high. So you pay interest payments then. And then you'll cut on your consumption, and when you cut on your consumption, then the businesses will have to not employ as many people, and then they'll start cutting. First, they'll probably take some of the open positions off, and then they'll try to see if they can make people work a little less. And then later the initial claims will start to come up, and then you'll see it also in the non-farm payroll. So there's a sequence to it, but that sequence is working perfectly now. We see it now with the demand. As I said, the most recent retail numbers doesn't look very good, and we see also that the unemployment is moving up because the companies are slowly starting to take action on this. And it's not like you are just seeing that immediately. This is a slow moving, or it's a super tanker turning, and it's like, again, how did you go bankrupt, and how did you see the recession coming? It's like, first it was gradually, and then it was all of a sudden. And that's the same thing we're going to see with the recession. I mean, it's going to be a slow moving turn, and then we're going to see all of a sudden, and then it's there. So the Fed will follow. They will start to see, and I hope that they see it. And as I said before, I think they are already very late, and I do not understand how they can even talk about I mean, the soft landing narrative is so naive that it's unbelievable.
And one of the things that I guess where I see a bit of a controversy with your call here is that if the economy is as weak as you think it is, why would the stock market continue to make new highs? Why do you see it going up to 6,100 to 6,200?
Well, because I mean, even though people think that the stock market leads, actually, if you actually do study this, you will actually see that what leads is the business cycle. It's the leading indicators that leads the coincident indicators, which are for instance, also the job market. And as we can see, we have the unemployment level starts to come up, and that is normally where we see the top in the market also coming later on. So the stock market right now will now be jubilant about the potential. That the Fed is going to be softening its stance, first of all, and then also to talk about the rate cuts. And that is what we see now. We see that the expectation of liquidity is what drives the stock market at this point here. And yes, I do see also that Bitcoin and crypto these days are actually having some tough days, but I think that the Nasdaq and the S&P will lead into that final phase here, and also because I expect that the dollar is starting to come down rather strongly now, which means that this, together with the rates and the expectation of the cuts from the Fed side, will create the perfect environment for stocks to go up, as investors do not think that the economy is going to fall into a recession. Because remember, it's only a minority right now that thinks that the recession is close. I mean, the sentiment is that we have a soft landing.
And I want to get your views on the level of speculation that we're seeing right now and how this feeds into your thesis. Because right now, AI is a big driver of this market. And when you look at NVIDIA, it's up 165% on the year, which just is astounding. But I believe the market cap is just over $3 trillion. $2 trillion of that has come here in the last 6 months. And to put that into further perspective, that's the market cap of Nvidia is now greater than the Toronto Stock Exchange or the market cap in Canada. but but do you think this level of speculation we're seeing right now with AI and so many other elements of the market, is this like the part of the final blow off that we're going to see?
If you go back to what I've said earlier on and what I've also stated in on my Twitter account, I said that already in October 22. I said when we get to the final phase of this, this is when we'll see euphoria. I didn't know at that point it was going to be AI. I said I say crypto would be a part of it, obviously, because any narrative you can have will be tied up together with some kind of crypto coin or anything like that. But that is what we're seeing right now. We're not in the final phase of this. We have not seen. We're not at the peak of level of this yet. We have seen the initial, the first few phases of this, but there will be much more, and that is when the next coming month here into the summer, into the early autumn, people will when the more you write on Twitter that a recession is coming, and the more laughing out loud and whatever people telling you that you're just an old man who doesn't know about the new economy. Well, then you start to get the euphoria that we have heard a few times. Also, we saw in 2000 and we saw in 2007. So yeah, it's starting, and I'm not, again, as I said, I had to move my goalpost a little in terms of the timeline here, but the target still stands, and what's developing, the sequencing of things is 100% what I've been laying out since October 22. So I'm just watching this and then expecting to see people then just getting more and more euphoric, and which just simply yeah, just underlines it to me that this is really getting into a bubble. And we have to remember, this is the largest bubble that we have had ever. We have a bubble in if you look at the market capitalization to GDP. Well, it's at all-time highs. I mean, it was a high just in 2022, which was a little 21, when it was just a little higher. I think we'll surpass that within the next few months here. And then we have also, if you look at the whole crypto market, even though I am massively long crypto right now, and Bitcoins, miners, and so on, that is because I know it's a bubble and I want to ride that bubble. But that does not make it less of a bubble. I mean, just the very thinking, or that everybody has an idea of that this particular coin is going to go to the moon, and even the ones that I hold. I mean, I could just hear people are just getting euphoric. And well, it's great when you long it, but it's also about getting out in due time, because this is a bubble, and when the bubble bursts, it's going to be bad. And that's what I said. So that's what I said also earlier on, 1929, and not as to 1929, but since 1929. Because the thing is, when we look at the chart here and the market valuations, if they have to come back to just sort of what would be normal, then this is going to be bigger declines in the stock market than we have seen in during the financial crisis or anything like that. And I also foresee a new financial crisis, and a banking crisis, and a pension fund crisis. And that is going to be, so much more severe than we have seen, at least before the financial crisis. But this time, there are more elements to it. So yes, I stick by my call. When we reach to the 6,200 target on the S&P, well, then I think it's time to get some chips off the table.
Okay, I do want to ask you about the banking crisis that you're seeing, but before we do that, I want to ask you about Bitcoin, and it's right now it's stuck in this tight range, $65,000 to $70,000. And the last time we spoke, I think you said your target was around $115,000. Is that still your target?
I think I moderated maybe to 110,000, but around those numbers. It's more like, the direction has been clear, and I still say 110,000. I think I use different techniques, and I think it could be from 105 to 112,000. So that's why I'm saying 110,000 each. Yeah.
I'm not a Bitcoin expert, but a lot of people seem to be puzzled with this lack of movement right now, where it's stuck in this very tight range. And a lot of people are saying that has to do with the halving process. Do you have any thoughts on that, or?
I don't do my analysis on halvings. I mean, this is something that people have, brought into the economic framework and understanding. What I look at is that you have an economy where you have risk-on phases and you have risk-off phases, and we are currently in a risk-off phase where you have where the economy is slowing, and the Fed is pushing, liquidity. Will start to push liquidity into it. We start to see that from other central banks. That will create a euphoric phase until the recession starts. This is a normal business cycle in those terms. And what we see then right now is in my books just a correction in the market before the most euphoric state of Bitcoin's rally, and also in altcoins. So I see there's a lot of indications that we're seeing a bottom here within one of these days here, and also that I think that Dixie is going to come down, which is actually what I think has been keeping it in check here. So I don't think the halving and everything else, what people are trying to put into it, has much to do with what we're seeing. We're seeing a business cycle development that will bring Bitcoin much higher into the final phase with liquidity coming in.
Okay, so let's talk about this banking crisis. And you also made mention of the fact that you think we're going to have some sort of pension fund crisis. But why don't you provide some more detail on that? What exactly do you see unfolding?
There are different kinds of crises. There's not just one type of crisis. People have to understand that you can have deflationary crisis, and you can also have a crisis where inflation can become a problem. And then what we actually had when inflation went up was not really a crisis because the economy was still expanding, but you had inflation coming up from 21 into 22. And the reason I was not paying, even though it went down a lot, the market, I have to give it that, obviously, but it was because the business cycle was still strong at that time. But what we see now and what I'm expecting ahead is that the business cycle has rolled over in my metrics, or in my model, and we're just starting to see that into the labor market. And the first part of that crisis will be a deflationary bust, which will be like what we saw during the 2008. So what we saw there will be again what we see here, and the Fed and every central banker of the world will of course jump on this. They'll not do it immediately. We also have to think that they are still scared of what they unleashed the last time. So if the market comes down a little, and they will probably just cut rates, and the rates are rather high now, so they'll cut rates, but they will not come flooding the market with what is needed. And again, they are late. They are looking out the rear mirror in terms of where we're going. So there needs to be something. Deflation needs to stare them in the eyes before they actually will start to move. But the moment they do that, I think the difference this time around from what we saw in 2008 is that you will not see people will not jump on the new money that they will that they will, if you start to see that the mortgage loans are not, as expensive any longer because the rates are coming down, or your credit card debt is not so expensive to hold. You're not going to say, well, let's spend another $1,000 here, or let's buy a new house, or let's buy a new car or something, which is what you need in order for QE or monetary stimulus to actually work. If you don't do that, if the people are the consumers just say, well, let's stick to this money. Let's see, because actually we had inflation just a little while ago, and also the interest rates were high, and we were struggling a bit there, which they are right now. Well, if you have that kind of behavior, then you will not see that QE is going to create the bounce, or QE or whatever they're going to introduce in terms of monetary stimulus that they would be expecting, and that happened in 2008. I think this time around that's a different scenario we have, the different setup we have, because people are simply a little scared there. So what will happen what I see ahead of us is that yes, the Fed will react, but it's not and also we'll see the market reacting on the Fed coming in. So we'll have a bounce in the market at that point. So remember, that's after the first serious decline that I see, and after the top in this year. Well, then I think they're going to unleash a sort of a stagflation, and we were not far away from that in 21 to 22. If you saw that, we were actually seeing, inflation was high, and if unemployment had been starting to come up at that point, and we have been at a different point in the business cycle, which we are now, well, then I don't think then we would have had another outcome. So the thing is that this time around, when they do this when jumping in, and people will be waiting a bit, then the unemployment rate will not decline again, and you will see actually that this money will be in their banks, and they will start to circulate the financial industry, which means that you could see another speculative bubble arise. So this is a little further out, but what I'm seeing in short is a deflationary bust. Fed comes in, and then we unleash a stagflationary period, and that stagflationary period is going to be the worst part, because this is where the Fed has very limited tool, or any other central banks, or any administration. Because if you pour more money on it or more stimulus on it, it'll just get worse. And if you don't, then you have the negative spiral. So it needs to work itself out, but there needs to be some structural changes to it. In the stagflationary situation, if I'm right on that, well, and you actually saw it during, as I say again, 21 to 22, you saw pension funds actually having large losses, because inflation was moving up, i.e. bonds did not do well, and you also the equity market's not doing well, so it was in the bear market below 20% down. That is not a good situation for a lot of pension funds, because they will have to be either in bonds or in stocks, and this time is going to be bigger. So I think there are going to be a lot of losses there. And actually, it's also part of the contractive wave thinking, so that into the final phase of the contractive winter, that you also have pension fund crisis, and that is what I see. I can see the drawings of that already. So I feel that part of the crisis. I have to say I'll be ready for it, but it's I think from a societal standpoint, it's not going to be a pleasant time.
So let me just summarize a lot of the points you just made. So right now, you think the economy is weakening a lot faster than the Fed believes, and therefore the Fed is way behind the curve, and they're not going to start cutting until it's too late. So the economy is weakening right now. Consumers are going to start feeling pain, and consumers make up the largest part of the economy, about 70% of the GDP in the US, and they're going to stop spending, and so it's just going to be a downward spiral. And with that pullback in the economy, then we're going to see a pullback in the stock market and pretty well any in every other asset class. Is that correct?
That's correct. And again, all that you just said meets the largest asset bubble in the world ever seen, and a crypto market, which is just pure speculation, and private equity market where every private equity fund in the world has been trying to find yield somewhere over the last few years and have been investing in, let's say, a lot of questionable unicorns or whatever. So the unicorn, trying to find the unicorn, right? So the search in search of yield. So all these startups, a lot of startups will also be probably be not having the kind of value, the kind of worth that these pension funds are. So there will be a lot of areas where we'll see that expectations of what we have in terms of value will simply will simply disappear.
And I want to get your views now on the federal debt levels, because I'm reading quite a bit about this, right? So the federal debt is around $35 trillion now. It's growing by $1 trillion every 100 days. And the level of interest to feed this debt, it's approximately $1 trillion. It's going to be $1 trillion this year in 2024. It's going to be the single largest um, budget or aspect of the budget. It's even greater now than defense, which I believe is around 750 to 800 billion dollars. But what does this do? And I'm surprised, like given these high interest rates and the cost of interest, why the Fed is taking such a long time to cut rates. Because when they go to renew or refinance this debt, they're not going to be doing it at 25 or 50 basis points like they were in the past. Now it's going to be at 3-4%, maybe higher.
Yeah, so I think the Fed will first and foremost actually not just maybe be focusing on the consumer and on the economy and make sure that you do not have inflation is not running too hot, or it's and also that it's not running too low, and also the second mandate that they have in terms of the unemployment rate. So I think that's what they focus on. But you have a point, absolutely. I mean, the U.S. debt is a problem. It is a problem, and debt is not just a problem in the U.S. In the U.S., debt, it's also the private debt amongst a lot of people, and I think that is what we're starting to feel now. That's also why when interest rates are coming up, we're actually quite vulnerable, all of us. I mean, there are other countries in the world that also have a lot of debt, and will also start to feel this. So I think the U.S. again will be the cleanest sheet also still, even though we have this huge debt, but there will be other countries in the world that do not have the reserve currency, and that'll be much worse off in this situation. So I think that will also be a part of it, and especially if I'm right in the stagflationary period, that is actually where I think it's going to be felt really really badly also, because if you're starting to see interest rate coming up and the debt levels are just high, then you will actually be suffering a lot also from a private and from a corporate and from a national perspective as well. So the U.S. debt level is a problem, but I don't think it's the biggest problem in the world. I think there will be a lot of countries around the world which cannot print their own money. Also, if in the EU we still have Greece, we still have some of the southern European countries that we think we saved, but actually their debt levels now are higher than what we had at the point when we saved them. The only thing we did for them was that actually we lowered the interest rates on the debt level. So that was why we in brackets saved them. If they have to start paying high interest rates on these debt levels, then they'll be worse off than the US. But it is a problem with the US. It's absolutely a problem, because sometime down the road, I don't think it'll be right here and right now, but it will become a problem that people start asking, is the US able to pay off this debt? I don't think it ever will, but there will be some vigilantes out there that'll think, okay, maybe we could speculate against this. So don't think that'll be the big driver of this now, as I said, but I think there'll be a debt problem around the world.
So you have said that this pullback that we're going to see in the financial markets will be the worst that we've seen since 1929. And I believe back in 1929, the Dow pulled back somewhere around 80%. Do you see that same sort of pullback this time in the financial markets?
Actually, I do. I do. And that's why I'm saying this. Also, it's not just picked out of nowhere. I mean, I've worked with structures. I work with models that shows me that the kind of structure that we see in terms of how the market has been rallying is indicating that if we could actually drop to levels we haven't seen since it's not that long ago. But the 2020 bottom of Corona could be one place that we could bottom out. I think it actually goes lower. I think it could be all the way back to 2016 with those levels. And if you take a look at some of the markets, how fast they have been going up compared to where we and how much that would be in terms of the decline, we are close to that number. So when I say that, it may sound like, wow, that's ridiculous. But actually, what is ridiculous is the pace of which markets have been going up over the last few years. It's not the decline here. It's more that the very people have had the feeling that they've had wealth, but actually it's been due to money printing. And if that's now coming home to roost, then I think it's going to be a problem for a lot of people, and we'll simply see that the value of our portfolios will be coming down strongly. So the models that I work with tell us 2016 could be a bottom, and that would be in some markets it will be more than that. I think there are some small caps it could be way more than that. There will be in the banking index. It'll be also as an 80% decline in in the banking index, which will indicate a big banking crisis as well. Many indications of that, and that's why I've said it also all along. It's not just a guess. It's like, well, actually the charts are showing me that these would structurally be the levels that we could drop to if we get that recession, and which it seems to be in the making.
So, given this economic backdrop that you foresee, what are you suggesting to investors in terms of how they position themselves?
Well, first of all, there may be a lot of different variations of an investor here, but I would say right now it's, if you like it, you should be part of it. You should dance while the music is playing, and dance would mean that the stock market is still going up. I would not be too much in foreign markets at this point. I actually think that the Nikkei potentially has topped. I think I called it a few weeks ago, a month ago. I saw that the Nifty was also weakening, and I think there's a new top to it now. But it's also, I think that will also come down. I think we have a top also in coming in DAX. I think we have around 19,800 to 20,000. I think the DAX will also. So a lot of the foreign markets are seeming to top out soon. Whereas I think there's more upside in the US, and that's quite normal because you normally see that you have a rotation from foreign markets into the US markets in the final phase of the business cycle. So I think that's what we see now, and that's also why we could see a rotation from more safe assets, the Apple kind of the Nasdaq, or sorry, the FANG stocks, I would say, into some of the more speculative ones into the final phase. So that's one thing, but that's just a play for the next, until Q3 at some point. And after that, well, there is a safe play, there is an aggressive play. If you think that the market can drop, significantly, you can short the market. If you think it's more about taking your money out and just staying in cash, that could absolutely also be a good way to do it. And there could be, also being long the dollar at that point. Not now, I have to say again. This is about when timing. I think the dollar will drop now until let's say September. But after that, I think there could be a good play also being long the dollar. So there will be different plays that when we get to that top, which will be the first part of the crisis, and then there will be something different when we get to the later stages of it. So first would be normal, risk off TLTs. It could be cash. It could be shorting the market if you're into that, and it could be sort of that kind of setup. But depending on risk profile, depending on the investor.
And I want to get your views on gold now, because the last time we spoke, I believe gold was around $2,000 an ounce. Now it's somewhere between 2,300 to 2,400 an ounce. In this environment that you see, do you think gold will perform well, especially when you talk about a stagflation? Would gold not do well in that sort of environment?
Stagflation will do fantastic, yes, but not in deflation. And I think gold is the outlier. If you compare gold to palladium, to platinum, to silver, to gold miners, gold is the only one that has been making a new all-time high in this cycle here. The rest of them have not. And I think what we're seeing is the speculation on gold is actually what has been driving it higher. So, and now everybody's speculating that, okay, then the rest of the pack will follow. I think it's the other way around. I still say in a deflation, I would not be holding gold. And that's what I've said all along. Has it moved higher? Yes, it has. And I give it that. But it's not the same as saying it's a fantastic asset to hold into a deflation, because people just need to think that, well, if the dollar starts to rise very strongly into a deflation, because of, and you have debt that needs to be paid off. And this is what you see when you have credit crunches, which I think we'll have this time around again. Why would you want to hold gold? And it will be sold off to provide liquidity. But again, when the Fed moves in, and you, as you also rightly said, in a stagflationary environment, yes, then you would be holding gold. But then you'll have, gold could drop to, again, I could still see 1250 on gold. So I'm just saying, why hold it from 2300 or whatever it is now to 1200, 1400, whatever it's going to drop to? In order, well, then you can get in, but that would be rather a big drop, and there will be so many other things that you should be holding in that period, in the deflationary period. So people had the notion or the idea that you need to hold gold into a crisis. Well, actually, the reason you hold gold is because if you want liquidity, you can get liquidity from gold, and that is why gold is a safe haven, so to speak. But it's just there are different crises. In inflation, stagflation, 100%, and I expect gold to go up much faster. I mean, even the rally in gold over the last couple of years has been, muted. I mean, nothing compared to what we're going to see. I mean, when we start to see that real phase, that real bull market unfold, well, then it's going to be much faster. But that requires a rather big pullback first, as I see it.
And so I just want to clarify something. So if gold's trading around 2,300 to 2,400, where do you see it going on the upside before it collapses?
So I've said all along, I could see it. I mean, potentially it could have topped already, and I think there's some weakness in it right now. I've said that I could also see it because I still expect the dollar to come down, and even though there's not 100% correlation, inverse correlation between gold and dollar, I could still see, of course, that a weakening dollar would support gold. So I said I could see it to 2,700 and still coming down quite significantly, but I would not bet because again, also gold usually sniffs up the environment of what is coming a little before. So I think you could see that gold could also drop from here. So I would not again. I think it's the most speculative play actually to hold gold at this point than holding risk assets, because risk assets right now with liquidity coming in will be fantastic. But gold will start to see that the deflation environment may be just around the corner, and then you could see something quite different develop. And I think also if you look at the Bitcoin gold ratio, I think Bitcoin will outperform gold. I can't remember what the ratio I'm expecting, but it's a lot that we could see Bitcoin outperforming gold over the next, let's say, 3 months.
Well, it certainly has outperformed in the last few years, and I guess that's why they call it new gold or digital gold, right? Yeah. But you raised a good point about the move in gold, and we're not seeing a corresponding move in the gold equities, right? And a lot of them are trading significantly below their NAVs.
I mean, that's been my point all along. For me, has been to look into exactly that, the gold mining companies. I think there will be a commodity play that will come around at the time. And again, asking me where to invest when the deflationary phase is over, which it will, when the Fed comes in with everything it got with the guns blazing. I think we will see a bottom in commodities, and we'll see that in gold and silver, and that will be the time for it. Because that will be the time, as I said, the stagflationary development can begin, and you will also not see a competition from all sorts of risk assets and so on. Even though and I think crypto will be way underwater at that point. So I think gold will really shine at that point, and gold, silver, and gold miners and so on. But it's about the timing, which phase comes first, and I don't see how gold will do well into a deflationary phase. And yes, you're pointing at the gold miners, GDX and so on are I have nowhere near where they were in 2011, and gold has been higher. So who's leading what? And is it gold that is leading everybody else, or is it everybody else that is staying sane and gold is the outlier? I say it's the latter.
Henrik, I want to get your thoughts now on what's going to happen if we look out 12 months. So if we're talking again in June of 2025, and I know you don't have a crystal ball, but do you think the markets are going to be a lot lower this time next year?
Yes, would be the answer. But again, then I have to think about also the timeline from now until we see the top. So yes, but the expectation is that we see a top at around 6,100, 6,200 in the S&P. And then that we go down as fast as we've been coming up. So often you see that the spike up is also the declines in kind of that slope. So I think maybe we could be around these levels here. We could be just a little bit lower than where we are here, but something along those lines, yes.
And so you don't paint a very positive picture, but if there was one risk to your whole thesis about the economy falling apart, what would it be?
Well, this is what people, what they ask me all the time. They say, well, what is it? How can you see that your thesis is validated? And I'll say, well, you don't base something like this on just one market. It's not a line in the sand. It's a thorough understanding of how the business cycle works, of how the leading, the coincident, lagging indicators work. We have a crossover in the leading indicators that leads to a crossover and a decline in the coincident indicators, and that is what we're in the process of seeing. So I would say that if we wanted to cushion it or something like that, well, the Fed should change direction immediately, and they should start thinking of how they can fight deflation. And I honestly, when you see some of the Fed speakers coming out and saying, yeah, we expect the inflation to be around 3%, 2.5%, or whatever it is that they say, and into next year or something like that, they really don't get it. They do not see the slowdown of the economy, and that is honestly a little scary. So I can't see what will invalidate this at this point here. We are seeing the normal business cycle unfold, and we are seeing the euphoria into the final phase. And also we have to look at it. Every time the Fed cuts rates, you have a market top within 1 to 2 months after that, and that's also probably what we're going to see this time around.
Well, Henrik, that was a very fascinating discussion. I always enjoy talking to you. And if somebody would like to learn more about you and your various services, where can they go?
So I think it's the most easiest to simply to go to my Twitter page at Henrik Zeberg, and well, there will be links also to other places where you can find me.
Once again, Henrik, thank you.
Thank you very much for having me on.
Well, I hope you enjoyed that discussion with Henrik Zeberg. And even though you may or may not agree with what he said, he still makes for a very interesting conversation. During times of economic uncertainty, like we're going through right now, the one asset that can bring stability to your portfolio is gold. And if you would like to learn more about gold and how it can benefit your portfolio, visit our sister company, hardassets.alliance.com. Hard Assets Alliance is a trusted platform that's being used by over 100,000 institutional and retail clients to buy and sell gold bullion and also coins. Once again, that's hardassets.alliance.com. There's a link below in the show notes. Once again, I want to thank you very much for being with us today, and I look forward to seeing you again soon.